we've moved away from the pits to the port to now from the pit through some value addition and beneficiation.
As Africa's mining sector enters a new investment cycle, the conversation is shifting beyond extraction to a far more complex question. How do you finance integrated mining ecosystems that include power, logistics, infrastructure, and local value chains? With partnerships now central to project success and bankability shaped by ESG and execution risk, capital is becoming more selective, more strategic, and more Pan-African. To talk to us about this, we are joined by Michael. Michael, thank you so much for your time. When we look at the theme for Mining Indaba 2026, it is Stronger Together, Progress Through Partnerships. From an Ecobank perspective, if you had to think about how the mining industry has evolved over the years from extraction to the kind of integrated systems that we currently have, what are your thoughts?
No, thanks for having me. We actually have seen an encouraging evolution of the mining sector. And the first emphasis I try to use is we've moved away from the pits to the port to now from the pit through some value addition and beneficiation. But more importantly, we're seeing an ecosystem approach to mining. We need to think about the infrastructure around it, but more we need to think about power, sustainable power. We need to think about the communities in which we operate in, and then supply chain to support it. So that evolution has really been great. Also interesting for the continent, and as a Pan-African bank, whose vision is an integrated Africa and a sustainable economic development, it's good to see the regional corridors begin to evolve as it relates to mining. So we think about the Lobito corridor from Zambia to Angola, and we also see integrated mining projects in the West African region, especially along the Sahel region. So that evolution of integrated regional plays, infrastructure play, ports, rail coming into play, we think is quite exciting, and we're happy to be part of those.
Let's build on that by reflecting on last year and taking into consideration some of the shifts that we have seen in African mining and what that meant for the financing of that sector.
Yeah. I think what we did see that partnerships amongst us as African institutions is critical to ensure sustainable financing. And the quantum, we also saw some really big projects, like the Simandu projects and a few others come to play, that one bank's balance sheet isn't enough. It's not going to cut it. And if you've actually moved through an ecosystem approach where you have to have money finance the ports, you have to have money finance the infrastructure, the roads and the rail, it was important that banks, as African banks, we work together and sort of bring a much bigger balance sheets to ensure that it's sustainable. Obviously, also bring our developmental partners in and international funding. So we've been able to leverage our reach across 34 countries, but also our global financing network to really crowd fund into the projects as and when it is needed. What excites me is the increased local participation in the value chain. Okay, so the ability to support local partners from a local content requirement perspective, and some of them often don't have the collateral needed, but our ability to work with the major sponsors involved to structure or fund the contracts that they get has also been very helpful, and that's an excitement that we saw in 2025, and we're seeing that sustain in 2026.
I want to tap into your experience because you have done quite a lot. What distinguishes projects that successfully transition from ambition to execution?
No, that's a very good question. I think what we increasingly see, and I mean, feasibility is a given, so we don't spend much time on it, but an alignment with the licensing regime, the regulatory regime, and the government, the host government, becomes imperative. Often when sponsors haven't thought through that, end to end and how that's going to play out, you have gaps when the project is started. So the projects that do well is the one where the sponsors take their time to ensure that there's good alignment among the regulatory bodies, around the licensing, and also factoring in the infrastructure play. Who provides the infrastructure? Is it the miner or is it the government, and how do they work together to ensure that that's at play? It's something that we actually seen a lot, and those who plan well with those actually do very well. Increasingly, we also see funding gap between feasibility and bankability, and often the project doesn't take off because that early funding hasn't been thought through properly, and so that means we want to see sponsors bring the banks in early. When we're in early, we can really come out with thoughts and solutions. Working capital, how do you bridge the gap before you've reached bankability? So those are key for me. And I also think we've seen players who think about the local community. Often we've seen agitation impact the mines going live, so they think holistically around that, how you support your suppliers, if you will. And we actually say the bulk of the financing, the bulk of a project is in the early stages, the preparatory stages, the construction, the infrastructure bit, not when first gold or first ore has come. So those are areas that we see. And so those who plan around those actually do well. The pitfalls is almost the opposite, right? Where there's not adequate planning, there's misalignment between the licensing regime as perceived by the sponsor and the regulator, and so you have fees and you have things that drag on, and not thinking through the broader infrastructure. So we have instances where mines are ready, but we haven't invested in rail to probably go to the port, or what processing is going to be happening, and so you've done a lot of work, money trapped, but then you can't get the final outputs to where it needs to go to. And so those are things that we keep in mind. And if we come in early, we're able to work with the sponsors to outline fully what we need to do, and we reduce the surprise factor. Yeah.
Given what you've just described, from the conversations you're having or what you're seeing, do you find that those gaps are closing, or are we still relatively in the same position we were when it comes to those gaps?
I think those gaps are closing. Those are closing because sponsors have gotten smarter. But increasingly, governments and the licensing authorities are also understanding what needs to be in place. Okay, so what I call licensing hoarding. You have players who get licensing and do nothing with it. I think governments are eager to see economic development, so they're following through. They're doing their due diligence well. Is this a partner who's got the necessary financing support, the necessary skills to deliver on what it needs? So the combination of those two and the alignment of those two is ensuring that we're seeing speed to market is actually quite good. And so the gaps is narrowing. I think folks have gotten smarter around what they're doing.
A lot of the projects that you see or that I see are multi-decade, multi-country. Talk to me about the role that you play and how different you are from a traditional financier.
I think for us, the benefits of being on ground, we've got deep local knowledge, deep local skills. Quite a bit of our work also involves advisory work, not necessarily paid advisory, but as a participant in the economy, we also can see how a successful mining project can lead to a more sustainable economic development. So increasingly, we provide input into mining charters, mining frameworks, and the like. We're able to leverage that to inform our own structuring of transactions. We're able to use that to also support potential sponsors. When they engage us in the beginning, we're able to share our thoughts, handhold them with regulators. So that's a central role that we play. We also appreciate what needs to be in place. We generally appreciate and understand where the infrastructure gaps are. And so we're able to bridge that gap and be in the midst of all of that in terms of going in there, local knowledge, share it. How do you come to the party to find solutions? And that increasingly has led to the size of book that we've provided from end to end, whether it's working capital financing, long-term financing. We provide performance bonds. And we do, what I'm enjoying these days is the invoice financing that we're doing. That invoice financing, increasingly, using the sponsor as an anchor, is helping us actually crowd in a lot of local contractors and suppliers that either two may not have their working capital to be able to do what you're doing. So our ability to look through a well-structured contract as a collateral for a supplier allows us to really, it increases the velocity of funding from the anchor to local contractors and suppliers, and the ecosystem continues.
As you think about the ecosystem, where is the biggest financing gap? Is it downstream, is it upstream extraction, or perhaps the downstream beneficiation?
We think it's the midstream and the beneficiation. It's still relatively evolving, if you will. So in some markets, we've seen beneficiation done well, but it needs to be done at scale. So there's a need for more confidence in it. So we've seen a place like Botswana with diamonds where you're doing a bit of the refining being done locally. And in some of the markets, I mean, DRC, we like CCC, which is the Congo Copper Cables. We see the mining of copper from the mine straight through a processing plant. And you have outputs of wire cables, and that's finished products that is being exported. So there are examples, but we need to push them at scale. So in the beneficiation area, we think there's more funding needed to actualize that. It does require a good bit of, in my mind, government participation. It's not a private sector approach. The enabling environment ought to be created. Often power is an issue, and the cost of producing or the cost of doing the beneficiation tends to be high. And when it's so high, then the end product is not as competitive. So you question whether is beneficiation as helpful as it needs to be. So working with partners, working with government, creating the right enabling environment, I think would unlock. The funding is there, but funding doesn't like too much noise and uncertainty. So you need to have the right people at the table to unlock it. And then the infrastructure space. We need modernization of infrastructure in most of these host countries, but also we just need more investments. The ports needs to be expanded, the roads needs to be dualized, rails needs to be revamped to ensure that things can move a lot more quicker. And all of that adds to the cost of production for a potential sponsor. So those remain bottlenecks, but we're encouraged by, through concerted efforts, partnerships with the right players, governments increasingly emphasizing a more integrated mining approach is helping. And I think we're seeing some examples that hopefully if it's emulated, we should see some change.
A little bit earlier on, you were talking about feasibility and bankability. What does bankability mean in African mining today compared to a decade ago, at a time now where we often talk about ESG, decarbonization, and execution risk?
Absolutely. Look, as a bank, we factor ESG, we factor traceability, if you will, and the right infrastructure being in place in our own analysis. Okay, so we will factor that in. When we've engaged the sponsors early, they actually appreciate what is required. So that is going into their thinking and the planning. And we're able to tell them there's a shortfall in your funding thinking. And that's important, that we've thought through all of that. The ESG requirements, and they're increasingly some of our funding. There are specific ESG requirements, so you can't unlock it if you haven't factored that into. So those are becoming very important. But again, the sponsors are attuned to what's required, and we share these things way ahead of time to go through. And traceability has become very important. Traceability, where is the output going? Obviously, there's a lot of illicit things happening here. So as a bank, you don't want to be funding a mine and the money goes into things that's generally, you don't know where it's going. But if you're not careful, it comes out and it hurts your reputation and like. So we're being very vigilant on these things. Quite a bit of the countries are requiring the repatriation of funding back into the economy. So what's changed from back in the day is governments hadn't focused a lot more on how the exports eventually come back to support their economy. So new mining charters insist on repatriation of a certain percentage of the exports coming in, which helps with foreign reserves that supports the economy. Obviously, the sponsors are able to take money out to service their debts and pay dividends as necessary. But so we're seeing a lot more impact from the mining activity to the governments, who in turn, I mean, the responsible ones are in turn reinvesting them into the infrastructure we talked about, which is then now beginning to lead to a more inclusive and sustainable economic progress and regional integration, if you will.
Michael, thank you so much for your time. For more insights, you can go to miningindaba.com.